So we just talked about the gross profit method, which is relatively simple, which only have 2 steps. Now let's look at the retail inventory method. Retail inventory method is a little bit more complicated compared with the gross profit method, but it's not that, so after we go through it, you will see that it's actually not that complicated. So first of all, we know the beginning inventory. So again, it is the formula, the beginning inventory plus purchase minus sales. So how much inventory we have sold equals to the ending inventory. And then for this formula, we can record the cost of each of those numbers, like the beginning inventory, purchase, sales, and inventory, either at cost. So what is the cost of the beginning inventory? What is the cost of the purchase? What is the cost of the inventories we have sold? And what is the cost of the ending inventory? Or we can also record it as retail. What do we mean by retail? Retail just means the current selling price. So what is the current selling price of the beginning inventory? What is the current selling price of the inventories we have purchased? What is the current selling price of the inventory we have sold? And what is the current selling price of our ending inventory? So those two at cost and at retail, those can be different numbers. Even for the same piece of inventory. So, and then for the retail inventory method, basically, step 1, we need to estimate a cost to retail percentage. So instead of the gross profit margin we have in the previous gross profit method, under the retail inventory method, we use a cost to retail percentage. And this number needs to be calculated. So there are different ways to calculate this number, but the general method we're going to talk about here. So we're going to use goods available for sale at cost. So if you still remember, what is goods available for sale? This is our beginning inventory plus purchase. Those are the goods available for sale. So we need to know the cost of the good available for sale, and goods available for sale at retail, which is just means the current selling price of those goods available for sale. And then we take the ratio of these two. So basically we take this to the ratio of these two numbers. And then that is the cost to retail percentage. So what is the percentage of cost to retail? And then the second step is we calculate the ending inventory at retail. So we calculate this number. How do we calculate this number? We take goods available for sale at retail, which is this number, minus the sales at retail. So the sales we're all selling at the current market price. So this will just take the sales the firm has during the period. And the difference between these two is the ending inventory at retail, which is the current market price of our ending inventory. We don't need to go take a physical count. We can just calculate it. We can just estimate this number from these two numbers. And then step 3, the estimated ending inventory at cost. So step 3, we need to move to this number, the ending inventory at cost. How do we know this number? We're assuming the ratio of cost to retail is constant. So after we estimated the ending inventory at retail, we multiply it by the cost to retail percentage we calculated in step 1. And then we're going to estimate the cost of the ending inventory. And then, so this is basically, this is step 1, step 2, step 3. And for step 4, we estimate the cost of goods sold. So this is step 4. We estimate cost of goods sold using the goods available for sale at cost. And the difference between the cost of goods available for sale and our estimated cost of the ending inventory. So that is how we get the estimated cost of goods sold. So our goal is always to get these two numbers. And this is how we get those two numbers under the retail inventory method. Now let's look at an example. So firm B has beginning inventory valued at 60,000 at cost or 100,000 at retail. Net purchase is 287,200 at cost or 460,000 at retail. Net sales during the period is 400,000. Using retail inventory method, what is our estimated cost of goods sold and cost of the ending inventory? So please take 5 minutes, look at this example, and you can pause your video for now. So how do we do this example? So again, let's write out the formula, the beginning inventory. Plus purchase minus sales equals to the, ending inventory. And then we can both have those at cost or at retail. So we know its beginning inventory is valued at 60,000 at cost and 100,000 at retail. Net purchase is 287,200 at cost or 460,000 at retail. Net sales is 400,000. And then, so what we need to know are those two numbers. And under the retail inventory method, our first step is, so we need to calculate a cost to retail percentage. How do we calculate this number? So we take the goods available for sale at cost, which is 60,000 plus 270,200. And we divide it by cost available for sale at retail, which is 100,000 plus 460,000. So, and then this is basically 347,200 divided by 560,000. And then this ratio is 62%. So this is step one. And step two is we need to calculate the cost of the ending inventory at retail. And how do we know this number? So we know the beginning inventory at retail, we know the purchase at retail, we know what is our current period sales. So our ending inventory at retail is 160,000. And then the next step 3 is we need to estimate the cost of the ending inventory, this number. And then in order to estimate this number, we take 160,000 multiplied by 62%, the cost to retail percentage we just calculated. So this gives us 99,200. And then the next step is to estimate the cost of goods sold. So this is estimated cost of ending inventory. And this is the estimated cost of goods sold. In order to estimate this number, we take 60,000 plus 287,200, and then we minus this 99,200, our estimated cost of the ending inventory. And this will give us 248,000, which is our estimated cost of goods sold. So this is the retail inventory method. And then the method, specifically the retail inventory method we just talked about, it is called the average cost retail inventory method. So in this method, the cost to retail percentage, it is determined for all goods available for sale. This is one specific kind of retail inventory method. And firm can also use other kinds of retail inventory method. Examples are the conventional retail inventory method. So under the conventional retail inventory method, markdowns are not included in calculation of the cost. So this is just another, we're calculating cost retail percentage a little bit differently. And the firm can also use LIFO retail method. So under this method, we have different cost retail percentage for beginning inventory and new layers of this inventory. So it's a little bit different as well, but the basic idea is still the same. And the firm can also using dollar value LIFO retail inventory method. So we have different retail inventory, cost retail percentage for beginning inventory and new layers, and different retail price index for beginning inventory and new layers. So it's also a little bit more complicated, but the basic idea is still the same. So those are just different types of retail inventory method. The thing you should know is the one we talked about, it is just one kind of retail inventory method.